Greg, we were going to talk about the 10-unit financing cap. Can you talk a little bit about that and how you can get around it once you have a maximum of 10 units financed?
Yeah, it's a real simple thing. So Fannie Mae and Freddie Mac, a lot of people listening have heard those names. They may not know what those are. Think of them as the underpinning basis of the mortgage banking industry. So mortgage companies in your town, whether it's Bank of America or Quicken Loans or Steve's Mortgage Company on Main Street, they are basically, when they're selling loans that are going to be purchased by Fannie Mae or Freddie Mac. Fannie and Freddie have rules around selling or offering loans to investors, and they have a cap, and the cap has been 10. It's been moving around here and there. What it means basically is that you can't, it's strange because when you get really experienced, they no longer want to loan you money, which is a weird thing. It has to do with the fact that their charter is to impact affordable housing, and so they tend not to want to go to larger investors that are wealthier and have bigger businesses and so forth. Getting around it is where you go to the next tier. There's a whole new industry of mortgage lenders that has emerged that are what's known as asset-based lenders. And all asset-based means is that when you've got a base of assets, like I have 10 properties, I'm buying my 11th, you can refinance all 10 of those into one loan. They'll use all the income from all the properties as the qualifying ratio or the qualifying income to apply to your qualifications. And it basically graduates to a new level. It becomes less of a residential loan adapted for investors, and it becomes more of a commercial real estate loan. And so it's a good thing because you can march your way right past 10 units and you've got a place to get your financing next. And that's relatively new.
That's right. Now, one of the things that I absolutely love about what you just said is there are options. Don't think that you're stopping at 10 units. Oh, no. You can absolutely get additional financing. You just got to get a little creative, but that's why you can play in this space. You keep listening to Think Realty Radio. Go to thinkrealtyradio.com and connect with us at some of our events as well. We have many events coming up this year, so check it out. Go to thinkrealty.com and register for the event. Let's shake hands and see what we can do for you. That being said, let's step into our next listener question. Clint from Bloomington, Indiana. I'm a huge fan of Bloomington, Indiana. That market is doing really well, especially that northwestern Indiana quadrant there. Question is, I'm new to the world of real estate. I live in a college town, though. I'm curious to know if you think it's a good idea to invest in properties specifically in college towns that will rent to students. Are college student rentals a good idea? What are the pros and cons here?
I love the idea of investing in college towns. So Bloomington, Indiana is a great example. And so it's the University of Indiana. They have just rudimentary supply and demand research will tell you that they've got 30,000 plus undergraduate students, and they have 13,000 beds on campus. So that means they've got 2 units of demand for every unit of supply on campus, which means there are 15,000 plus students that have to live off campus, period, right? I love college towns because of that raw analysis then goes to some more of the qualitative stuff, like there's an alumni loyalty factor. These towns, when you know when you go to a school, that city, that town becomes part of your life forever, even if you don't go back very often. But for a lot of people, they wind up staying there. Like I'd be interested in asking Clint if he went to school at the university and then he ended up staying there because there's a whole ecosystem of employment that surrounds major universities like that. There's also something else about college towns where you're renting to students, and that is the downside is the perception is they're going to wreck the place. You're going to wind up with keg parties and holes in the wall and things like that. So you may have some maintenance issue. The upside, and this is I think a major mitigating upside on the plus side, is that mom and dad are paying the rent and Junior is living there.
That's right.
Junior is the one. Now, whenever you have a situation where the consumer of the product is disconnected from the payer of the product, what tends to happen is the prices rise because the consumer is the one choosing. Like let's use healthcare as an example. Let's use university tuition as an example. In both of those cases, the person paying the bill isn't the person choosing the service. So you go to your doctor, it costs what it costs. You don't even know what it costs. You find out later when the insurance company pays whatever they're going to pay. That disconnection of the person making the purchasing decision from the person who's actually paying for it tends to drive prices up. Universities. What's my student loan say I can afford? It's 80 grand. Well, the tuition's 80 grand then, right? It's going out of control, the cost of universities, in part because the people are not price sensitive who are driving the decision, i.e. the student. Same thing here. So when Junior wants to live on that street because it's the coolest street or it's closest to where he or she wants to be, but it's an extra $50 a month, mom and dad aren't complaining about it. It's like, where's Junior going to live? It's not razor thin in terms of their requirements of cost. And so what tends to happen is you'll get a higher rent per square foot overall because of that disconnect, and that'll translate to a higher yield. So I love the idea of college towns. I'm surprised that the institutions, the big players in this space, haven't yet figured out that university towns are a great investment thesis. I think that'll happen over time. So that's another reason, get in now, because later I think it'll probably get crowded with some more Wall Street oriented money. So getting in first, having a lower basis. And by the way, quickly on the Bloomington market, if I look at my favorite chart, I always go straight to this 20-year price performance chart to see how the market performed during the stress test, to see how recession-proof it is, how volatility defensive it is. What you've got here is a 2.5% annual appreciation, so lower than the national average. National average is 3.5. Bloomington is 2.5. But it doesn't even register the housing boom or the housing bust. It is just marching along at a gradual upward trajectory with no volatility. And if you could achieve that kind of calm during the last 20 years, what you've got is a market that has basically proven that you can't shake it. Okay, the anchor of demand in that market is the university. The university is not going anywhere. So there was no housing boom. There was no housing bust. It is as stable as you can get. It's about as stable as I've ever seen in the country. And so that's worth noting, that it's bedrock that you're investing in.
I'm a huge fan of just the university bubble, right? Like the same thing when I went to Ann Arbor, Michigan, and it was great. Right? Nothing affected the town, absolutely nothing. And we had the auto industry crash right next door, right? Guess what happened to the city of Ann Arbor? Nada.
Nothing.
Zilch.
Yeah.
Absolutely. It was crazy.
That's a great example. It's a phenomenal example. So I'm looking at the job diversity. My second favorite chart is the job diversity chart, which just shows the employment base and how spread out is it among different sectors. And, we usually see that the number one job, picture a pie chart with different slices. In this case, trade, transportation, and utilities is number one. That's always a good one. That means basic, fundamental commerce. Okay, trade, transport, utilities, the basics of business, not government. Okay, that's a good one not to be first. Second one is education and health. That makes sense. It's a college town. Third one is leisure and hospitality. That also makes sense, and that's all college town. Nobody's going to Indiana for the summer vacation. That right. Travel and leisure is all geared towards university, and government is less than 1% of the job base in that town.
That's right.
I love it.